The last week in the market has been fairly mixed, a lot of industries performing very well, but largely the Mag 7 and some others currently down and fairly significantly. And if we just take a step back and look at 2025 so far, we are seeing the market is still looking very poor. Many companies that are standing out are in fact down double digits, and in fact we can see this is one of the worst starts to a president's tenure solely based on the large drop we are seeing in the markets. But that can also be a great thing for long-term investors, because when we look around at companies and what they're trading at in terms of valuation, some are starting to come down to some very attractive levels which we may want to add for the longer term. And that is the sole focus in today's episode. We're going to run through very quickly, not more than a couple of minutes, on 18 stocks that pay dividends that we believe are offering some very attractive values, and we're going to explain to you why and give you our own valuation and price target. The first one is the semiconductor company TSM, where we get an incredibly rare strong buy rating right across the board from Seeking Alpha, Wall Street and Quant. Not something we have seen for any other company on this channel. Now it is trading towards the lower end of the 52-week range. It is up 9% over the last year. Year to date though, down 23%, losing nearly 1/4 of their market cap in 2025 alone. But when we zoom out over the last 10 years, this is a company that has massively outperformed the S&P, up 509%. And if we take a look at their valuation, they do sit at 16.7. That is below the 5-year rolling of 22.1. That is what we would call a severe undervaluation signal. However, we will note currently on offer the yield of 1.81 is pretty much in line with what they have offered over the last 5 years. And if we were to look at this valuation model, which is based on the average of the PE over the last 5 years, the blue tunnel here indicating the expected fair price. Always great to see a company where this is increasing over time. That is what you want to see from any company you're either investing in or ones you're considering them to be worth more as time goes on. And for the first time over the last 12 months, we now see disparity between what the company trades at and even the lower end of the blue tunnel. That in turn is called a severe undervaluation signal. And as we said, we're going to jump straight into our valuation for Taiwan Semiconductors, where we get to $225. Now it is the average of these three models that you see on screen, and typically on the channel we do our deeper dives. We run through every single one of these models. We cover the inputs and the outputs. We're going through 18 today, fairly rapid fire, so we're going to get straight to it. We always then add a margin of safety, kicking off with 10%. We execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for TSM, a buy at around $203. Then we keep going till it's near the current trading price. And what we're effectively saying in today's episode for TSM, not at a 35% MOS just yet, you would have to wait for $146, but sitting somewhere today between 30 to 35%, and that is maybe sufficient if you do want to incorporate tariffs, if you want to incorporate geopolitical tensions. With Wall Street themselves, very bullish. They see this at $242. Remember, we got a triple buy rating across the board where they see upside of 59%. As we said, we're going to run through 17 other stocks. Give us your thoughts as well. Do you see these as a buy, hold or sell? The next company we're moving on to is Zoetis, with a double buy from Seeking Alpha and Wall Street, trading towards the lower end of the 52-week range, down 2% over the last year. Year to date, down 9%. But over the last 10 years, similar to TSM, it has massively outperformed the S&P, although to a smaller degree, up 210%. We also notice not only is the forward P 24.5, much lower than the 5-year average of 32.8, but it is the lowest the company has offered over the period. Again, another severe undervaluation signal, with the confirmation of that on dividend yield theory, which, as always, tells us a company is undervalued when the current yield sits above the 5-year, 1.35 above 0.82, so for Zoetis a double severe undervaluation signal, although we should really make that 3, as we can see disparity between where the company sits and the bottom end, so Zoetis definitely one looking like further consideration. And our intrinsic value gets to $226. Again, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Zoetis or any others. But as we do keep on going in terms of a margin of safety, you can see you are getting quite a very healthy amount. At 35% is where we see the company right now. Wall Street themselves, $208 price target. They have the buy rating 41% upside. Again, another great opportunity to consider, but as always, let us know if you want us to take a deeper dive into any of these stocks. Now, before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a copy of 35 severely undervalued stocks for the month of April. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So as we said, click below, you can sign up and read straight away. We then move on to Stanley Black & Decker with just one buy rating from Seeking Alpha, trading pretty much bang on near the 52-week low. It is down 36% over the last year. Year to date, hammered down nearly 30%, and over the last 10 years, you would be down 43%, but again, bear in mind, this is if you had bought the company 10 years ago today, and if we were to look at the all-time high, you'd have to go back now 4 years ago where it was worth $220. In terms of the forward P though, 11.3, the lowest on offer over the last 5 years, significantly below the 5-year of 19.5, and the yield right now at 5.73, massively above 3.27. In fact, again, similar, the highest on offer over the last 5. And given the yield is fairly high, we'll also just show you that the dividend does look to be safe with a score of 70, and that we also get that severe undervaluation signal. Blue tunnel has been increasing over the longer term, but pretty much from the back end of last year, we have seen the disparity grow further and further. That is why we would classify this as severe undervaluation. Now, intrinsic price gets to $96. Now, given the current trading price, we are again looking at another company which will give us a very nice margin of safety. In fact, as we keep going, you're getting at least 40%. Wall Street themselves, we do notice price target $97. They see 70% upside over the next year. And again, we did see the dividend does look to be safe with a yield near 6%. Maybe one for those to consider that do use those dividend payments for their daily expenses. We then move on to the REIT, Real Estate Investment Trust, Rexford Industrials, REXR, with a buy rating from Wall Street. It is trading towards the lower end of the 52-week range, down 23% over the last year. Year to date, down 16%. Over the last 10 years, it is up around 105%, marginally underperforming the S&P, and we can see again the lowest forward P to AFFO, a metric we use for REIT, at 15.7, where on average it's been 33.8, and similar to SWK that we just reviewed, a very attractive yield, 5.3%, the highest on offer over the last 5 years, and we actually get to see a very safe dividend score at 81. On top of that, we do again get another severe undervaluation signal, but something interesting to note, this company, at least over the last year, have been trading at these severe undervaluation levels. And in terms of our intrinsic value, it does come to $45, disparity against the current price of $33, so again, a nice margin of safety. And as we do in fact keep on going in today's episode, not at 30% just yet, you are pretty much getting between 25 to 30, very attractive, again, yield near the 6% point. Wall Street themselves, $43 over the next year, in turn translating to 30% upside. We then move on to NEE, Next Era Energy, with a double buy from Seeking Alpha and Wall Street, trading towards the lower end of the 52-week range, up 4% over the last year. Year to date, down around 8%. Over the last 10 years though, outperforming the S&P, up 153%. And we can see again, it is trading very low at 18.1 in relation to the 5-year at 27. And also the yield on offer is above 3.42, the 5-year of 2.27, with another company that has been trading at least over the last 12 months at severe undervaluation. Now our intrinsic price arrives at $82, and we are looking again continually at companies with some very attractive margin of safety. This one today is sitting at 20%. Wall Street themselves, 29% over the next year, $85 price target. Is this one you see as a buy, hold, or sell? We then move on to Accenture with a double buy from Seeking Alpha and Wall Street, trading at its 52-week low, down 10% over the last year. Year to date, down 20%, so just over the last few months, wiping off 1/5 of its market cap. Over the last 10 years, though, it has outperformed the S&P, up more than 200%. It also trades at the lowest forward valuation of 21.8 over the last 5 years, and also giving you the highest yield on offer at 2.1, above the 5-year at 1.46, whilst also pretty much for the second time over the last 12 months, giving you disparity between where it sits and the lower end, so nice severe undervaluation signal across all three methods in today's episode. And our intrinsic value does come to $377, and when we take a look at the margin of safety for this company today, ticker symbol ACN, you are getting at least 25% at the current price, and Wall Street themselves seeing this at 362 over the next year, upside of 28%. We then move on to Railroads, Canadian National Railway Company, with a triple buy, seeking alpha, Wall Street and Quant. This one also trading near its 52-week low, however down 22% over the last year. Year to date, down only 2%, one of those that hasn't been massively effective as we've seen from the previous companies today, and over the last 10 years, it has underperformed the S&P up around 50%. However, we do notice the lowest valuation over the last 5 years at 17.4, as well as one of the highest yields on offer at 2.5. And probably not surprised to see there is disparity between where it sits and the bottom end, so severe undervaluation again for CNI. Now, our intrinsic value of $114 will give a margin of safety. At 10%, a buy at $103. At 15, not far off, but not quite there yet. So for CNI, near 15% MOS. Wall Street themselves, $120 price target, 21% upside. Give us your thoughts. Maybe you like CNI, or perhaps you do prefer other companies in the railroad industry. We then move on to UNH, where it was absolutely battered after their earnings, so do check out that episode we did over the last few days if you want a deeper dive. We get a strong buy from Wall Street, a buy from Seek Alpha, trading pretty much right there at its 52-week low, down 5% over the last year. Year to date down 10%, and if we just look at that last day, in fact on Thursday it was down 22%. Now over the last 10 years it still has massively outperformed the S&P, up 283%, whilst also trading at the lowest valuation over the last 5 years, 15 versus the 5-year of 20, and offering the highest yield at 1.85% above the 1.42 average. And you can in fact see now that massive disparity, in fact just that 1 day drop taking it quite some way below the bottom end. So UNH, based on these models, giving us severe undervaluation. And when we take a look at the intrinsic value, $553, you are getting a nice MOS for what we would say is a high quality company based on the metrics. At 20%, not quite there yet. So for UNH, 15 to 20% MOS. Wall Street themselves, $640 price target, 41% upside. Let us know perhaps you are buying this when it did drop just a few days ago. We then move on to S&P Global, a strong buy from Wall Street, a buy from Seek Alpha, trading towards the lower end of the 52-week range, up 12% over the last year. Year to date, down 7%. Over the last 10 years, massive outperformance of the S&P, up 336%, whilst trading at a forward P of 27 with the 5-year at 30, although the current yield on offer pretty much in line with the 5-year average. And this model here telling us for the first time over the last year, it is slightly below the bottom end, so we do get that potential undervaluation signal. Now, our intrinsic value of $546 was derived from the DCF model, so we can show you how we arrived there. We have the free cash flow year on year, average growth at 82%. Now we've gone for a growth rate of 10%, which is lower than analyst targets. In fact, the lower end of our low, medium and high, we have 10, 12 and 14% respectively. Remember, numbers here are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for SPGI or any others, but based on 10% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 546 indicating 18% upside. Now we'll show you full transparency for those that believe it should be higher at 12, $634.37, and at the 14% level, $735. 59% upside. We want to be extremely conservative, so we are going for what we would say is fairly conservative at the 10%. You are still getting a fairly attractive margin of safety. Again, we do believe this is a high quality company. Not at 20% just yet, but you are in fact getting bang on 15%. Wall Street themselves, a lot of upside, $610, 32% just in the next year. We then move into the Mag 7 with Meta Platforms, a strong buy from Wall Street, a buy from Seeking Alpha, trading towards the lower end of the 52-week range, up only 1% over the last year. Year to date, down 14%. Over the last 10, no surprises, massive outperformance of the S&P at 515%. And if we take a look, there was a time where this company was trading around $90, although you would have to go a couple of years away. And we can see a forward valuation of 20 when the 5-year average has been 23.4, so we would say undervaluation signal. And this is also confirmed when we take a look at this model. Blue tunnel increasing over time, but for the first time over the last year, slipping outside of even the bottom end. So lots of signals pointing to Meta Platforms being undervalued. And when we get to our intrinsic value, it comes to just under $700, again derived from the DCF model, where we have used the lower growth rate of 10%, although you can see 10, 12 and 14 the different value and upside that it would yield. If we take a look at margin of safety in today's episode, again quite an attractive one for what we would say is a high quality Mag 7 company. Not at 30% just yet, not far off, sitting somewhere between 25 to 30. Wall Street themselves very bullish, $764 price target. They see 52% upside. We then move on to QSR, Restaurant Brands International, with a strong buy from Seeking Alpha, a double buy from Wall Street and Quant, trading towards the lower end of the 52-week range. Down 11% over the last year, down 3% year to date. Over the last 10, underperforming the S&P, but it is up around 52. Trading at one of the lowest forward valuations over the last 5 years at 17.2, with the 5-year at 21.3, and a yield touching near that 4% point with the 5-year at 3.4. Although we should make you aware the dividend safety currently does hit 45 borderline safe. Again, let us know if you want a deeper dive into any of these companies. And we can see severe undervaluation based on this model, although for the large part of the last 12 months, it has been trading right underneath that point. And our intrinsic value comes to $78, so you will get a margin of safety. In fact, as we keep on going, you're getting at least 15% up to $67, 20% pretty much where we sit right now, in fact, so 20% MOS, fairly attractive yield, 27% upside, $80 price target. Do you see QSR as a buy, hold or sell with a fairly attractive dividend yield? We then move on to Novo Nordisk with a double buy from Seeking Alpha and Wall Street, trading at its 52-week low, down 54% over the last year, wiping off more than half of its market cap in 12 months. In fact, when we look year to date, down 33%, losing 1/3 of its market cap just in 2025 alone. And over the last 10 years, it is up around 105%, marginally outperforming the S&P. We can in fact see it wasn't that long ago where it was trading near the $150 mark, but we do get a severe undervaluation signal. Forward P 14.3, not only below 30.4, the 5-year average, but the lowest it has been valued at over the last 5 years, with the highest yield on offer over the last 5, 2.8%, when over the last 5 years it has been at 1.41. And we get a 99 very safe dividend score here, which is the highest score obtainable, and therefore a dividend cut for this company looks extremely unlikely. And probably no surprise then when we do take a look, Blue Tunnel has been increasing over time, but we notice the opposite trend for the share price. It has been decreasing, disparity only getting bigger and bigger. Again, another severe undervaluation signal noted. Now our intrinsic value does come to $101, where in fact you can see the low, medium and high growth rate. We've gone 14% with a $100 value, 74% upside. As we do in fact show you, you are getting quite a significant MOS in today's episode based on that projection. As we in fact keep on going, you're getting at least 40% up to $61. Wall Street themselves very bullish, $85 price target, 46% upside. And we'll also show you, for those that believe 12% to be more appropriate, you are still getting a very large margin of safety. In fact, at today's price, you're getting 30% up to $61. And we can do the same exercise for those that believe we should go even lower at the 10% rate. Again, you are still getting a margin of safety at 20% around the $60 mark. As always though, give us your thoughts about these companies. And then we move on to Lam Research with a double buy from Seeking Alpha and Wall Street, trading towards the lower end of the 52-week range, down 30% over the last year. Year to date, down 12. Over the last 10 though, massive outperformance of the S&P, up 731%, trading at a forward valuation of 16.6, below the 5-year of 20.2, and giving you a yield of 1.44, above the 5-year at 1.15. And we can also see that severe undervaluation signal noted for the first time over the last year. Blue Tunnel increasing, but the stock price decreasing, definitely a signal for further consideration. And our intrinsic value arrives at $91. When we take a look at the MOS in today's episode, you can in fact see you're getting bang on 30% around the $64 mark. Wall Street themselves, a lot of upside, 47%, price target $94. We then move on to Alphabet with a double buy from Seeking Alpha and Wall Street, trading near their 52-week low, down 3% over the last year. Year to date, down 20%, wiping off 1/5 of their market cap in 2025. But over the last 10 years, they have outperformed, up 427%. And also offering the lowest forward valuation at 17 over the last 5 years, below 22.2 as their 5-year average. And probably no surprise to see that severe undervaluation signal well below that bottom blue end tunnel. Now, intrinsic value of $226 is derived using a growth rate of 12%. And when we do show you, you are getting a very large margin of safety for a Mag 7 company, which we do believe is high quality. Again, check out our latest episode just yesterday where we ran into this company in quite some detail, but 35% MOS near $147, so you're getting somewhere between 30 to 35. Wall Street themselves very bullish, $210 price target, 39% upside, and we'll show you for those that believe the growth rate to be more appropriate at the 10% point, you are still getting a fairly attractive margin of safety. In fact, at the 20%, a buy at 158, at 25 at 148, so sitting somewhere between 20 to 25. Do let us know though if you do see this as a buy. We then move on to the semiconductor wide moat company ASML with a double buy from Seeking Alpha and Wall Street, trading near their 52-week low, down 30% over the last year. Year to date, down 8%. Over the last 10, massive outperformance of the S&P, up nearly 500%. With one of their lowest forward valuations at 23.6 over the last 5, their average has been 34. The yield on offer pretty much at the 1% point with the 5-year at 0.84. And no surprises, we do get massive disparity between the bottom end of the blue tunnel and where it sits, so lots of severe undervaluations in today's episode. Now our intrinsic value does arrive at just over $1,000, where we have used a growth rate of 14%. Over the last 10 years, on average, it has sat at 41, but again you can see the different growth rates giving different upsides and target prices. And when we do take a look at the margin of safety today, again another company like pretty much the majority today where you are looking at a very significant amount, near the 40% at $634. Wall Street themselves, $943 price target, 47% upside. But again, we can show you at the 12% growth rate, you are still getting a fairly large margin of safety. As in fact, we keep on going in today's episode, you're getting pretty much 30%. Again, Wall Street price target, 47% upside. And for those that want to see even lower at 10%, bearing in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, again, whether it's for ASML or any others. But even on the 10%, you are still getting a very attractive margin of safety, pretty much bang on at 20%. We then move back into the Mag 7 with Microsoft Corporation, a strong buy from Wall Street, a buy from Seeking Alpha, trading near the 52-week low, down 11% over the last year. Year to date, down 13%. Over the last 10, massive outperformance of the S&P, up nearly 700%. And we see a forward P of 27, lower than the 5-year at 32, and disparity from where the company sits pretty much the first time over the last year, so definitely one again for further consideration. And our intrinsic price of $488 is derived using a growth rate of 16%. When we take a look at that margin of safety today, you are getting at least 20% up to $390, 30% at $341. So in today's episode for Microsoft Corporation, we see a 25% MOS. Wall Street themselves, $510 price target, 39% upside. Is this one you have been buying over the last few weeks? We then move on to AstraZeneca with a double buy from Seeking Alpha and Wall Street. Wall Street 4.41, not far off the 4.5 to flip this into a strong buy. Trading near the 52-week low, down 2% over the last year, up 3% year to date, so outperforming the S&P. Over the last 10 years though, up 88, underperforming the S&P, although marginally, where we do get a forward P of 15 below the 5-year of 18, and the yield sitting pretty much in line with the 5-year average, although we are noting some disparity between the 2 points here, so undervaluation noted. And our intrinsic value of just over $87 is derived using a growth rate of 10%. As you can see, 12% for the lower rate, 52 for the upper. And when we take a look at a margin of safety today, as in fact we keep on going, you're getting around 20% at the $70 mark, 25, not quite there yet, somewhere between 20 to 25. Wall Street, they see this as a $90 stock over the next year, in turn giving it 34% upside. And then finally we move on to Salesforce with a double buy from Seeking Alpha and Wall Street, near the 52-week low, down 11% over the last year. Year to date, down 26, losing more than 1/4 of its market cap. Over the last 10 though, massively outperforming the S&P, up 265%. And we can see it trading significantly below the 5-year average, 22.1 for a forward PE with the 5-year at 31.7. And we do also notice disparity between where the company sits and the bottom end, although we would point out for the first time today, the expected price has been slightly decreasing over time. And our intrinsic value of $371 is derived using a growth rate of 12%. As in fact, we do keep on going based on this in terms of a margin of safety. You are getting a fairly large one, 30% up to $260, 35% around $241. So we would say for Salesforce, a near 35% MOS. Wall Street themselves, very bullish, $373 price target, 51% upside, and we can show you at the 10% rate in terms of what the margin of safety would be, as in fact we do keep on going. You're getting at least 20% up to $258, 25 not quite there, so near a 25% MOS. Wall Street themselves though still very bullish. As always, give us your thoughts about these 18 stocks. Have you been buying any, or maybe you see them as a hold or sell? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in a Patreon where we cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.